Hello, I'm Brent Wilsey, and with me is Chase Wilsey. We're from Wilsey Asset Management. And today the ECB, which is the European Central Bank, they cut their interest rates again. They were already negative. They're now negative 0.4. They were a negative 0.3, so they're cutting them again.
Yeah, and it's been interesting. There's been talk, oh my gosh, we're going to see negative interest rates here in the U.S. We're not going to see negative interest rates here in the U.S., but that's the route Europe has chosen to go.
It is a little different route than we did take. They do have quantitative easing, which is QE. They now pay out $22 billion a month in QE. Now it's in euros, but it is I'm putting in billions for you in our dollars. What they're also doing that's very interesting is they're paying banks to loan money. What they're actually doing is saying, banks, here's $1 billion. In 4 years, pay us back about $950 million.
It sounds like a great deal for the banks, and it sounds like a great deal for the economy, as I think it will really help spur the economy going forward.
That's exactly what they're going to do. They're going to spur the economy, put that money out there for people. Will this help? Well, it is going to help. It's going to be the same thing here. What they're doing is they're borrowing from the future. Now, the ECB is like our Federal Reserve. So what they're doing is they're borrowing from the future so that you're going to have a GDP growth of probably 2.5%, but you're not going to have the big peaks and the big valleys. They're going to have growth like we have, about 2.5% on the GDP.
Sounds nice, kind of take away that volatility and just kind of smooth it out.
And it's kind of funny. People think they want the volatility because they want the big ups, but you got to take the big downs. So smooth is a much better way to go. All right, let's talk about sports a little bit. Let's talk about the NFL offering streaming rights. This is like huge that they did it, last year once?
Yeah, last year was the first time they offered this, and Yahoo actually bought the rights for $17 to $20 million. Now, I'm not sure if it was a profitable decision for Yahoo, and that's a whole different story about Yahoo, the company. They're in a mess right now. But
right, yeah,
that's a story for another day.
Not a good investment right now.
But this year, they're offering all the Thursday night games and the London games as well. So it comes out to a total of 21 games. And they're saying, Amazon, Facebook, Netflix, Google are some of the interested parties. And they're saying, these are up there for auction. So you don't have to buy all the rights to all the games. You can kind of pick and choose.
And what I'm thinking here too is that's a lot of money. $20 million per game. You're talking about $500 million. Can they sell that much advertising? I mean, I know Facebook can do it, Google they said, but that's still a lot of advertising online to raise that much money.
Yeah, well, some companies like Amazon, what they're hoping to do is actually spur Prime membership. They're saying, well, if you want to stream the game through Amazon, you're going to have to be a Prime member. Mm-hmm. So that's one interesting way, and I love this because it's just like, I don't know, could be a future way to get rid of cable.
And it's going to hurt like a DirecTV a lot, isn't it?
Yeah, Sunday Ticket, I mean, if they go forward and say, we're going to offer all our games for streaming rights, well, DirecTV loses their big advantage for that NFL Sunday Ticket.
Could be the wave of the future, and this does mean probably problems for the cable companies.
Yeah, I would definitely stay away from those companies, cable companies, as they are highly leveraged right now too. And once they have lower earnings, it's going to be hard to pay back that debt.
Yeah, exactly. Their earnings will go down and so forth, and could be problems for them down the road. Staying with the sports team, let's talk about Dick's Sports. Dick's Sporting Goods, symbol DKS, 50-week range, a low of 33, a high of 60. Right now, about 45. Is that a pretty good deal?
I took a look at it, and I've been following Dick's Sporting Goods for a while. Love the store, love the company. I've played sports my whole life growing up and stuff, and I was like, this is one of the companies I want to take a look at. But I did take a deeper look. Current ratio right now stands at about 1.52. However, very interesting here, the quick ratio comes in at 0.24.
Ooh, that's kind of not that good, is it?
Yeah, well, I mean, it kind of hurts their liquidity, but the reason for this is they are a retailer, so they have a lot more inventory on hand. They have to keep all those baseball bats, the baseball gloves, all those sporting goods. Those are all inventory. So that's why there's a big discrepancy between those two. However, very nice here, their debt to equity is 0.33. Essentially no debt on the balance sheet. I think you guys are catching on. We love when there's no debt on the balance sheet.
And also when you talk about this low debt, that's very important. Understanding the numbers of the current ratio is so high, but from inventory, what happens, you can't sell those bats in a fire sale for 100 cents on the dollar. You might sell them for 25 cents on the dollar, so liquidity goes down. Make sure the debt is not that high so they don't have that liquidity crunch.
Exactly. And getting our target price, as always, going forward, we're going to take a look at January 2018. Estimated earnings per share on a GAAP basis are $3.54. This gives us a target sell price of $58.41, about 30% away from the target sell price, 30% difference between the current price and the target sale price.
And I like this company in Phoenix. When I was there, I went into Dick's Sporting Goods for the first time ever. I like the store, nice looking store and so forth. So I think this is worth looking into. But remember, this is the start of your research, not the end. Make sure you get deep into these numbers to understand the business really well.
Yeah.
So maybe you think this investing thing is hard, and maybe you think it's easy. Well, a lot of people think it's easy and they start doing it. Oh my gosh, it is a hard thing to do. So what we do, we make it easy here for you. We do all the analysis. You want to come in for a free consultation, go to our website, smartinvesting2000.com. Send us an email right there, or give us a call, 858-546-4306 for that free consultation. Come in, sit down for a conversation. We'll talk about what we do and listen to what you have to say.
Yeah, and make sure you go to that website now so you can sign up for our upcoming workshop on Saturday, March 19th from 10 a.m. to 12 p.m. We'll be hosting it at National University in Rancho Bernardo, and at the workshop, we'll be analyzing a company that could potentially be a buy in our portfolio. That company is locally based Qualcomm. We'll be reviewing stock fundamental analysis and why it's successful. We'll be showing you when to buy and sell a stock, and going over the 5 common mistakes the average investor makes.
And also, too, we show you everything we do. So it's not a sales seminar. You'll actually learn what we do. I'll be honest with you, you're not going to be able to do what we do, but we show you what you actually do. So hope to see you there.